to touch on investing in shares. So if you give me about, yes, that's what I was asking, Blessing. I was asking why do we do average? You can unmute yourself, huh? Is that clear though? Do you understand that part?
Yes, sorry, I was trying to type, but yeah,
No,
it's a bit
just
of
talk to
time.
me. You guys, by the way, are not supposed to type. Just talk to me.
Oh, okay.
So yeah.
So I just wanted to make sure if you were asking the reason why debtors are averaged, or like I
Yes,
didn't.
that's the question. Why is the debtor's average? Why is that? Are you able now? Do you understand now that part? Why is that?
Yes, I could answer, hopefully if I'm right.
No, go ahead.
Um,
Yes.
I think it's because if there are too many debtors that take too long to pay, the company could risk giving away a lot of credit.
No, actually, we answered the question. So the reason why we average, because remember, your balance sheet or your
Yeah,
statement of financial position only
yeah.
gives you a picture at one point in time.
Okay.
So it doesn't cover the entire period. Let's say, for example, your income statement that you are dealing with, right,
Mm,
speaks about the year, the full year.
mm.
It's not the same as the balance sheet. The balance sheet will only be talking, for example, about at the end of the year. This is the balance sheet at the end of the year. It's
Mm-hmm.
only at one point in time. It does not cover the full year.
Okay.
So that's why you take an average. The reason why you take an average is that you are, and by the way, you're going to have questions where they will ask you for an average. So for the year, the income statement is for 2024, but they will provide you information for the datas of 2023 and 2024. There is a reason why they do that. Is because they want you to take an average for beginning 2023 to 2024 divided by 2, so that you can get a sense of, it's almost like you are putting it on a period term,
Okay.
so that you are covering from one point to another. In other words, you are making almost your balance sheet becomes now a motion picture, a movie. You see?
Yeah.
Yeah, so that you can see over a period. Otherwise, if we are dealing with things that covers a period of a year and one thing that is only covering one point in time, you see, you can't make a calculation.
Mm.
That's why you will see everything that comes from your balance sheet, it will be averaged. And
Okay.
that is very important because your balance sheet, like I said, is only a snapshot. It's only a picture at one point in time. But your income
Mm.
statement covers a period. All right?
Yeah. Yes.
Yes. All right.
Thank
Clear. So guys, I'm moving then to this part. That's the last part I'm going to touch on. So if you give me a couple of minutes, we should be done. But I hope you guys have read this, because this is going to be also an important part where many questions will come. Investing in shares. Obviously, remember in our first session we talked about there is two type of financing. There is a debt financing, right? And there is the equity financing, right? So when you are talking about investing in shares, that's equity financing, right? Obviously, they touching on few points. it is relevant for you to read this. But one thing that I've even added for you guys is these two pictures here. I think that they're very important. So give me just 2 minutes to cover this. Technical and fundamental analysis. Obviously, the technical analysis, they look at past trends of how the price of a share has been performing. Remember, there's 3 ways that you can invest in shares. What do you do if you want, where you are, you say, okay, I have enough money, I want to invest in shares. You can either buy directly, purchase shares from the primary market. It means that there is a company that, like a startup, that has started, it's a private company, and it's inviting investors to come and put in money. That's the first way that you can invest. Or you heard me talk about the GSC, the Johannesburg Security Exchange. That is called a secondary market. The people who have bought in the primary market are also trading those shares in a bigger market called the the stock exchange, right? Now, to invest in the stock exchange is quite difficult because you need to buy, you can only invest by lots of 100. So let's say you want to invest in a particular company, you need to buy 100 shares of that company. So it's not for everybody. It's for people who have really a sizable uh, uh, investment amount, right? But for the rest of us, like me, the way that I invest in a unit trust. And you, all of you have heard about the unit trust, right? If you don't know about that, ask your bank. So when I was telling you that you need to have an investment account with your bank, that's basically a unit trust, right? But all the financial institutions, Liberty, Sanlam, Old Mutuals, they offer unit trust that you can invest in. It is a quicker way to invest. And what it's done is that we are a pool of investors who invest together. And that will prevent us from spending quite a lot of money to buy lots of 100 shares, right? That's difficult. To buy that on the GSC is difficult. But there is this group that will buy. Uh, um, it is a collective investment, and it is managed, and all the investors put their money. So, for example, with 500 per month, you can invest 50 Rand in 10 different companies with this system. So that's also another way. They could ask you this question: what are the different ways to buy shares or to invest? You need to know that. Technical versus fundamental analysis. What are they talking about? Technical means simply they are looking at past trends, right? They are looking at past trend of the movement of the share price. All right. So why are we talking about this then? You would ask. Why are we talking about this? No, because when you want to invest, you need to analyze a company before investing. You're not just going to go and invest, right? You need to analyze. And when we're talking about analysis, there's two main type of analysis. There's a technical kind of analysis, and there is a fundamental kind of analysis, right? That's all it's about. The technical will look just at past trends. They don't care about the underlying value of a share. They don't worry about that. They focus more on supply and demand. So they will look at past trends, how these shares has been operating, and they use it to predict how this share is going to behave in the future. Okay, so it's a kind of analysis, right? Fundamental analysis, on the other hand, is very different because it's an analysis of financial statements. We look at what we've been doing with ratios. We look at the financial statement, the health, the management, the competitive advantage, competitors, the market, to analyze a company. So we're looking at historical and present data with financial projection as a goal. Okay, so I wrote all this for you so that you can just go through it. It's quite easy, right? So the prediction about movement in the share price, usually for the long term, are based on the company's fundamentals and valuation. Fundamental analysis involves making investment decisions based on the difference between the fundamental value of a company and the current price. So that's why I've given you this graph, obviously, very important for you. So you can see the real value of a share, but then also you see the market value. So we believe that over time, the market price will always try to meet the intrinsic, the real value of the share. So, but when a market price is higher than the real value of the share, we say that that share is overpriced. Easy. When it's below the intrinsic value, we say that that share is underpriced. So some people will buy a share that is underpriced because they believe that, you know what, the share price is going to rise. I hope all of you can see my mouse. So they can buy here. So if you are a fundamental analyst, you will analyze the intrinsic value. You say, you know what? I think this share is underpriced. I believe that the market value, the share price is going to rise. So can you imagine if you buy when the price is low and then you sell when the price is high? You make a profit. All right? So welcome to the world of investment. That's what it's all about. So your purpose is to buy when the price is low and to sell when the price is high. Okay? But imagine somebody who's buying an overpriced share and then all of a sudden the market price falls. He's going to lose money. Are we clear? Just by this picture, do you understand? All right. So, but what is look at how technical analysis is different, because it's identifying and exploiting non-random price pattern and trends in the market. So they believe in not what the fundamental analysis is doing. They don't believe in that. They believe just at looking at past trends in order to predict future, right? So they believe in studying the graphs depicting the price and volume. They believe that all information is already contained in the share price. It's already there. So we don't need to look at the fundamental value of a share. That doesn't matter. They believe that investors' emotional response to price movement leads to recognizable price pattern. All right? So you know this. What does it remind you of? Economics, supply and demand. They believe that the price will rise dictated by supply and demand. If something is in high demand, guess what can happen? And there is not enough supply. The price of that thing will rise. But that's your economics module, right? It is finance. We touch on many things, right? But these things you need to read so that you understand a little bit, right? But it doesn't mean that the fundamental analyst is right or is wrong, the technical analyst is right or is wrong. Read this section. What does it say? It is warranted to make use of both technical and fundamental analysis when making investment decisions. Remember, this is about investing in equity, right? In shares. In general, fundamental analysis will tell an investor what to buy or sell. Fundamental will tell you what, but technical analysis will tell you when to buy or sell. So both are important. Is that clear? So if you get a question, don't say technical analysis is wrong. No, it's not about that, right? Both are useful. Is that clear? Is that clear? Are we there? For a moment, I thought that you were sleeping. All right, so we're going to finish with the gearing and investment ratios, right? So you have also, remember, we have 4 group of ratios we have been looking at. Profitability ratios, liquidity ratios, gearing ratios, and investment ratios. Oh, Blessing, you say that you asked a question. Let me check your question before I move. All right, so how does a company like Old Mutual, for interest sake, become insolvent? It is caused by having to pay out. Oh, you mean too much investment, or I'm too many? Remember, insolvency has to do with liquidity. So Old Mutual needs, it definitely has, somehow you are right. So if, for example, people are asking Old Mutual to give them, are asking Old Mutual to pay back the money. Let's say there is a panic. So that is not only the case of Old Mutual, but could also be cases of banks. You've heard about banks that collapsed. What happens sometimes, there can be a panic in the market where people feel like, you know what, our investments are about to go down, so we want our money back. So the bank, if the bank is not liquid enough, it will not be able to honor everybody who wants their money. So what does that mean? It means that it's having a liquidity issue. And that's why we have ratios to calculate the liquidity of a company. It doesn't mean, depending on the nature of the business that you are doing, sometimes it's fine to be not to be illiquid. But if you have to settle your debts, you need to have the cash. That's what it's all about. I hope you understand that part, all right? So remember, guys, we talked about the profitability ratio. What are the profitability ratios, guys? Remember, your gross profit margin, your gross profit percentage. You know how to calculate your gross profit, net profit, net profit divided by sales multiplied by 100. You know these things, guys. Please do not disappoint me. Look at these ratios, practice them. There is examples there, practice them. All right? So don't be confused. If there is a ratio that confuses you, please put it on the platform. Let's work together, right? Gearing. So now I'm touching on the 2 last, gearing and investment ratio. Remember, your gearing ratio could be debt to equity ratio. So why do we do this kind of analysis? It's because the more debt you have, the riskier your company is. We know equity is less risky, but it is more expensive because you are giving out a chunk of your business. All right? One of the reasons why debt is riskier is because the bank would want its money. Whether things are going fine or not, they need to be paid. You remember, equity, you can hold on paying out your shareholders. Let's say you are going through a difficult financial situation. Equity investment, the manager or the financial manager can decide on not paying out the dividend, right? Or on taking the profits and reinvesting that profit into other business so as to grow the business. We spoke about this last time, right? So that's the equity. So equity is less risky in that way, okay? But the debt, it's more risky because if the economy goes down or things are not going fine, you still need to meet your obligations with your creditors. They don't have a share in your business. They loaned you money and they want you to pay them. Is that clear? That's right. So equity investment, it means that we're going to share the risk together with our investors, with our shareholders. That's why it is less risky. But with debt investment, your creditors will not share the risk with you. They loan you money, they lend you money, they want you to pay back the money to meet your obligations, right? And there could be penalties if you are not meeting your obligations, right? And they need to be paid first. So what are the tools that we're using to know how in debt a company is? Debt to equity ratio, right? This is one of them. It is calculated by dividing the company's total amount of long-term debt divided by equity, the total amount of equity. Non-current liability divided by total equity. Okay. Total gearing, we take the long-term liability divided by the capital employed. What is the capital employed? It is all the equity plus the long-term liability. Guys, practice this. Very clear. Is this clear in your textbook? Okay. Now we finish with the market value ratio. Let's finish quickly with this because earning per share, EPS, you all know. You take all the earnings or the net profit, earnings attributable to ordinary shareholder or your net profit. Net profit. Net profit means you have deducted everything. Now you have the choice with that net profit. Either you can invest, you can retain that net profit to invest in other projects to grow the business, or you can pay out some of that net profits to your shareholders. When we pay it out to our shareholders, what is it called? Ooh. Guys, I repeat again. You have your earning per share. What is earning per share? Is basically your net profit. After everything has been deducted, you remain with the net profit, right? That net profit divided by all the number of shares can give you an indication of what each share receives. That's why we do net profit divided by the number of shares. But it doesn't mean that we pay it out. We don't pay it out. Now the decision must be taken by the financial manager, either to retain some or a portion or all, to reinvest that net profit into other projects for the company in order to grow the company. But when they decide to give some of that money back to the shareholders, what is that called? When we want dividend. Thank you, Jesse. It took long, guys. I was so worried. And that's your dividend. So you need to make a difference between your EPS and your dividends, right? But obviously, EPS does not take it. If you have to compare your company with other company, you don't know how many shares are in issue in other company. So you can't really compare the EPS of your company with other company. A good way of comparing is by using your PE ratio, price earning ratio. Very important. This will allow you to properly compare. And you need to read this. Guys, please read this. If you do not understand, I am available for you. Post questions on the chat. Take screenshot. Send it on the chat. Let's work together. You need to understand these things as you move on. Otherwise, you will struggle. And the problem is they are not difficult. They require you just to read. Read and practice. Read and practice. All right? Because remember, I want to put if we are comparing a company with companies in the industry or companies in the entire market, we need to have a tool that makes all those company being able to be compared. And that's why we need to use the PE. Very important. It's a good indicator. But you need to understand, what does a lower PE means? What does a higher PE means? Right? And this example, I want you guys to do example 2.8. I repeat, please do example 2.8 and tell me if you understand it. And if there is something that you don't understand, because it is straightforward, it requires you to simply read. Read, do it, and let me know if there is any issues. Be clear, guys. You have dividend yield, dividend payout. These are not formulas to just take. No, no, no. Don't do that. It's not going to help you. Understand, what does that mean, dividend yield. Okay? And why do we use an annual ordinary dividend payout? Why do we multiply it by 2? Because the dividend most often is paid twice a year. So that's why we multiply, we put it annually. Annually ordinary dividend per share divided by the current share price equal the dividend yield. These formulas will not be provided in your exam. So read and understand them, please. And you have everything. Oh, yes. Yes, blessing. They are not provided. And that's why when I say please read, understand them, is because once you understand them, they will stick with you forever. So it's not a matter of just saying, oh, let me memorize. What is the dividend payout ratio? Oh, I need to take the dividend per share divided by the earning per share. But you never read it. Why do they do that? Okay? So once you read, you understand, and sometimes I highlight even for you what you need to focus on. For example, for the dividend yield, a company with a high dividend yield can be considered as risky, as it implies that the company is returning a huge portion of its profit back to the shareholders as dividend. What does this tell you? It speaks to you about when you talk about dividend, you must always look at the other side. What is also retained? Remember, I told you there is a mix. The company can decide to retain a portion and another portion it pays out, right? So the dividend yield speaks to that. So when you have a company that is giving too much dividends yield, right? Too much dividend, it is considered risky because what are they investing for the growth of the business? You understand? So there is a logic. It is not just a matter of, oh, I know the formula. Yeah, but you know the formula, but can you remember your question will ask you to write the formula, to write the answer, and to explain what that means. And these are basic stuff. They didn't write 10 pages. They write just a small section to explain to you the dividend yield. All right? Are we happy? Are you guys fine? All right. So before I go, any questions? Let me see who I have left. Majority have run away, but let me see who I have left here. I have only Jesse and Blessing. Wow. I appreciate that. I appreciate that. But all of you who are listening to this recording, please follow exactly the instructions that were given to you. All right, perfect. But so guys, remember your exams is coming this week. It's very important that take each and every day. If you have not finished properly this learning unit and you have not properly practiced, please do it and take the past papers that I've provided to all of you and practice for your test because it is coming. And that's it. You just need these 2 chapters to be ready for your first test. And I'm sure you will do well, but please understand very clearly why it is very important for you to practice. Practice is so important, it's so key. And you will see that once you practice, it's going to become so easy to understand. But you have me, you have your classmates, reach out at any time. We are a community of practice, right? So guys, let me thank you. And that will be it for the lesson.